All right, great. Thank you, everyone, for dialing into the Astoria Group CIO call. So I'm John Davi, the founder of Astoria Advisors. I have the honor of having Jeff Winokur from Wisdom Tree and Thomas Heidenberger from T. Rowe Price. Thank you, guys, for joining.
Absolutely, our pleasure.
So maybe, Jeff, you'll just give your background, your quick background and your title and role at Wisdom Tree, and then we'll let Thomas do the same, and then we'll go into the macro asset allocation.
Sure, we'll do the 10-second intro. I'm like the equity guy. I'm the stock market guy over at Wisdom Tree, which is the ETF house. Probably 99% of our asset base is ETFs, and I'm the one who comes up with all the outlooks, right or wrong, about where the stocks are going to go, which groups are going to work, what do we think about currency hedging, all that jazz.
All right, I'm Thomas Heidenberger. I am the bond guy from T. Rowe Price, so I'm on the opposite side of the spectrum here from Jeff. T. Rowe, as I'm sure many of you know, is predominantly a large equity franchise or equity powerhouse. However, we do have a pretty good slug of fixed income assets. So I am a fixed income portfolio strategist. My specific remit covers all of our investment grade multi-sector strategies with a focus on global investment grade corporate bonds.
Right. So we'll get right into it. The idea is to have, similar CIOs and, kind of big thought leaders, of which obviously you guys will qualify. I'll just say on Astoria side, we think the equity picture is pretty clean in the sense of we think you should rotate away from the Max 7, right? Max 7 is expensive. We think there's a lot of opportunity in equal weight, mid-cap stocks, let's say, other sectors besides tech. We think you should mix in international. We like international stocks. Mix in some value and some dividends because it's good to mix factors, right? You get high up in the first frontier. The fixed income side is where I do think that you have to be more dynamic, I'm going to say. So maybe we'll just start with you, Thomas, because, the 10-year just feels like a big range, right? And then there's a lot of discussions about, corporates versus high yield versus mortgage-backed securities. And I think that part is where advisors who are our clients, really struggle, right? They kind of get what I'm saying on the equity side, but it's really the fixed income side where they're not really sure what to do. So maybe you can kind of walk us through the house views on fixed income.
Sure. Yeah, let me start by saying one thing that may or may not be abundantly clear to your clients. The fixed income universe is in a completely different spot than it was several years ago. And what I mean by that is quite simply that the fixed income market has detoxed itself away from central bank excess, meaning we are no longer in a world of zero rates. Global central banks have all moved off the lower bound of that 0% interest, not just here in the US in 2022, but we started seeing that in Europe, Eastern Europe in 21, and then later in 2022. So what does this mean for investors? You have significant opportunities across the fixed income universe, not just in a global ag type fashion, but also, European corporates, high yield, you name it. There are plenty of options for yield out there. However, I would caveat that the way we arrived at this destination, the ride was a pretty bumpy one. If you remember, March of 2022, the Federal Reserve started aggressively hiking, as did other large orthodox central banks. Those yields, we were coming tight spreads, low yields. That led to a positive correlation impact, which basically led to the biggest bond market, bear market that we have seen in generations. Think about U.S. investment grade corporates, double-digit losses, the ag, double-digit losses. A lot of people looked at their statements and said, hey, what is typically supposed to be my diversifier did not act like that because we had duration, interest rate risk. So a lot of people were blindsided by that. So fast forward to today, we're on the other side of that hump. So you have a lot of yield, and you have basically what that means for you is that you have the main driver of your return source in fixed income is going to come from clipping those coupons. Now, also the benefit is you have what's called a yield cushion, meaning that now that you have this yield, your fixed income holdings it's going to act as a bit of a buffer should you get moves higher and wider in spreads and yields. And we can talk about it a little bit further, but I thought that might be a good spot to lay the land of where we are in the fixed income landscape right now.
I don't disagree. I mean, we think bonds can do a lot of work for you in the portfolio now. When I began Astoria in 2017, I think a year later, the 10-year was at, 80 basis points. And, it threw risk off completely, right? You had people kind of moving out of cash and buying stocks. And, maybe you don't need to own as much equities now because the bonds can do a lot of your work. So Jeff, you're very prolific on Twitter.
Is that a good thing? Go
well,
on.
You got a big platform. You got Siegel, at Wisdom Tree too. We actually just pointed to the stocks for the long run. We had, we were trying to get a client out of cash to buy, some bonds recently, and we showed and equities too. And we showed them, the Siegel's 200-year chart.
Right.
How could you get data 200 years ago on the equity market? I'm sort of joking with you. You've got data that goes back to 1800s on the equity side.
Yeah.
So what's the house?
And how reliable is that data? It's, you're trading underneath a cherry tree, that type of thing. But go on.
Yeah. So what's the house views? How are you guys thinking about portfolio construction right now on the equity side?
Yeah, and I'll see if I could piggyback off of some of the things that Tom said, and you get a pretty good feel for it because you have the advisors with the inbound questions and the things that we pick up on our office hours webinars with a lot of the nature of the questions that the advisors type in, and you have, some of the lines of thinking are, well, now that the Fed, well, it's a very stealth easing program here, it's super slow. Don't we get that benefit in the back part of 25 or into 26? From those cuts. But, kind of thinking about like what Tom was saying, the excesses of the central banks when it was all QE forever. The reality is that there's been quantitative tightening going on for some time to the tune of about $2 trillion from the United States. And so I think that that's something that's going to be certainly a headwind. The issue is when you think about as you said, portfolio positioning, if that ends up being a situation where the S&P is at 5,900 and we want to chop around this summer or have some downside, that what we've seen is the risk in equities tends to be among the bull market leaders, which is Mag 7 type stuff. That's where the most windfall declines were. It was discretionary communication services and tech in that February 19th to April 8th downdraft. And then you also have, and, is this like one of these things where it's okay, time for us to get excited about Europe for the 8th time in the last 15 years and then and then get rug pulled on it. We have some theses that are on with some of these exposures that we think are pretty live. And by the way, you guys just froze, so I don't know if it's my Wi-Fi or your Wi-Fi, but just let me know if I freeze up. Think about the Trump trades around November, December, and everything that was really on. It was American exceptionalism, U.S. dollar strength, U.S. equity outperformance, and so on. And really, 2025 has seen a flipperoo on all of that. And we've been kind of saying things along the lines that are consistent with the narrative, but that people are still missing. Namely, that there's been a few big reports written by major players in Europe, like Mario Draghi, Enrico Letta, for example, the Draghi report and the Letta report, talking about reforms. And I think that it's one of these things that's really thematic, which is it's really kind of like it's hitting the fan. We can't keep up with the Americans. We can't keep living like this. And we've done, I love Europe. I love it. It's a wonderful place, wonderful people, but it's kind of like Disneyland. It's become that way, and it's become the rap. And that's why people haven't played these markets for so many years. And I think Europeans are kind of saying, okay, it's time to have some reform. Now, you commonly will hear people mention, for example, the German bazooka, whether it's 500 billion euros or €1 trillion, infrastructure and defense as kind of the countervailing point to Doge. But also just think about reforms. There's some real moments happening in places like London, in places like Paris, saying, okay, we don't have any tech sector. We have to change that. We have people choosing to IPO on the NYSE and the NASDAQ. I mean, China's having the same issue as well in its bear market. And I think that that's one of these things that's thematic. You're going to get these trickling in of announcements as the years go on, which is kind of like a catch up to the United States. So we kind of have this bearish vibe in the tape this year in that we're virtually unchanged in US equities, but a lot of the developed stuff is up sharply year to date. We got funds that are 15 to 18%, and it just doesn't feel that way.
Well, yeah, and if I can just tack on from a fixed income perspective in Europe, I mean, as you know, Germany has been, as you can tell from my last name, I have a little bit of a vested interest in Germany, but you know, they have for decades been the perennial sick child of Europe. And the way I would characterize what you're seeing, at least in rates, credit, FX, it has been a divergence between the US and Europe, whereas our exceptionalism is getting tested and Europe is just saying, hey, we have hit a fork in the road. It is time to go do our own thing. You know, I do think that fiscal bazooka, it's going to take some time, right? I mean, Europe has some structural challenges they're still going to have to get through. But if you just look at coming back to the divergence, thinking about central banks here in the US, we could afford to not move. Europe, the ECB, BOE, they can't afford to move. So they're firmly in a cutting cycle. So I think for fixed income, you know, there's some opportunities to be had there still.
Yeah, and I mean, just kind of continuing on with some of these concepts where, you know, Tom was mentioning everybody moving off the zero bound, and you know, why, John, why would we be bullish on equities in 2017, 2018, 2019? It was Tina. Right, there is no alternative. This continued well into COVID. Jay Powell was kind of too late to the game there with transitory inflation, and it was like, okay, let's buy S&Ps, let's buy everything. And the Tina trade really has reversed. It's been one of the things that had been past tense, the reason why you want to get extremely bullish equities, and it's dissipated virtually everywhere except for in Japan. You still have kind of near the zero band, not at it anymore, but for all intents and purposes still there, and there's still a one handle on 10-year JGBs. But I think that's one of the things that's kind of arisen here as we age in the bull market for equities. I don't know if we would have, did the bull market end on February 19th, and now we've just gotten back to it. Who knows how to define terms here, but that's a situation, a cost of capital situation, John.
I do think that there are like these 10-year trends that, kind of we should think that, like, for 10 years, I started in 1999, and for 10 years afterwards, nobody wanted to own the U.S. equities, right? It was all about emerging markets and U.S. small caps. And U.S. small caps went on a 10-year run. It was up 120% from like 2000 to 2010. Emerging markets were up 150%. We're just in this 10-year trend now where it's been the U.S. dominance. I'll turn it over to you, Tom. The one thing I would say is, like, I did this Barron's interview February 10th, and the title was like, Astoria expects big fat correction, and we nailed the timing. And S&P fell 18%, Qs fell 25%, and then they asked me for a follow-up interview on April 10th, and we said, we're not as bearish anymore. And one topic that we talked about in the interview is like this Vanguard put. So, my background is I was hired by the guy that created the Greenspan put, this guy, Steve Kim. He wrote the white paper on the Greenspan put, got a lot of credit. And basically, I think that, Vanguard, they actually have a person that communicates like their order flow every day on the sell-off. And they just train their army. And it's every day they take in $1.5 billion. And, we're going to have Mike Green, who talks a lot about this at the Astoria Macro Summit, later this year, October 20th. And, I do think there's something about, Vanguard, gets their retail army, just buy every day, buy the dip. And you didn't have that 20 years ago. But Tom, on the credit side, what I would say to you is, like, people tend to gravitate towards, IG, obviously treasuries now, because there's a lot of, room in the front end. But, we in our firm, we do use like mortgage-backed securities as a sector. We quite like a lot. My guys like it, Mike and Nick. And how is T. Rowe Price thinking about like credit sector allocation right now? Maybe kind of go a little bit deep into a specific area.
Sure. I actually want to make a point about what you said about ETFs. So don't let me forget before we get off this call. There are some things to talk about there, specifically within the ecosystem of fixed income. But if you go through credit, I mean, it's hard to believe, and Jeff touched on this. I mean, we have completely round tripped what we saw at the beginning of April across credit. It is value's hard to come by, really. So if you sort of just like, let's just kind of stagger down here. Let's just start with investment grade corporates. We are back at spread levels in early April. So the value's been squeezed out. It's not attractive. So we're actually underweight the long end of investment grade corporates, strictly on a valuation perspective. There is, however, a technical underpinning in the asset class where we're going to still see some continued demand for two reasons. One, dealer balance sheets are very light on a U.S. investment grade corporate. So you have a little bit of a bid or sort of like a buyer of last resort just waiting in the wings there. The second, if you just look at all-in yields, we have a consistent buyer base in investment grade corporates just where all-in yields are. You have liability-driven investors, like, for example, pensions and insurance that are going to continually come out there and, sort of put that floor. But valuation's pretty tough. High yield, similar story. We do still think that, we're not going to see a broader, huge default cycle. The high yield market is a completely different market than it was pre 2015, 2016, before the oil blow up. It's a higher quality market. All sort of the bad actors have been more or less flushed out. Bank loans, continue to do well in a higher for longer environment. As long as the Fed stays on hold, that's going to be, continue to do well for the asset class. EM, favor corporates over sovereigns more on an idiosyncratic basis. You have to think about how the dollar is doing relative to other currencies out there to keep in mind, but we favor corporates over sovereigns. And then as you started to get into securitized, there's still some value in securitized, but that largely has to do with the fact that when securitized, they follow corporates, but at a lag. So if you see corporates rally, call it 50 basis points in the span of a month, securitized is going to take probably an additional month to catch up to that. So you can still, harvest some value out there. We actually do not favor agency MBS because if you recall in those first 10 days of April, you started to see some serious cracks in that asset class right around April 9th as the Treasury market was selling off. It was not behaving as a diversifier in credit like it's supposed to. So we actually think that there's just so much embedded rate and convexity risk within the asset class that we are underweight. And there were a lot of money managers, our competitors, that had big overweights to the asset class going into April. And so we think that still has not been completely pushed out of the market. Still some value within non-agency RMBS. Fundamentals are strong there. We think we can do some good work there. And then within asset-backed, staying up in quality, avoiding areas like subprime. So should you get a downturn in the consumer, you want to be just very cautious of those parts of the market. I hope I covered as much as I could.
John, the Vanguard put. Can I keep running with your Vanguard put?
Sure.
And then can I
All right.
jump
And I pulled up over here. All right. I'm going to say this with this. This is a proviso. All right. 5944 on the S&P 500 over here on this screen. Let's call it 6,000 to do the back of the envelope math. Okay. If the bears get it right this year, S&P earnings would be about 250 maybe, right? Not 260 or 270. So at 250, like let's say that, tariffs keep droning on. We still have this issue. You're at 24 times projected earnings. Okay. So it's because I'm about ready to say something that's really, really bullish.
Yeah.
but we're not at 10 or 15 times earnings. Okay. We're at 24 times earnings. So now let me lay out with you this concept. When we were children, not a lot of people had a 401k. I don't remember that being really a thing. I guess people had them, and my household did not. Okay. And now it's ubiquitous. And as the years have gone on, okay, whether the market's up or down, a certain class of people are going to put every 2 weeks up until they hit the $23,000. The husband and the wife, $23,000 apiece. and the 7,000 in the trad IRA and the 7,000 in the other trad IRA. It's going to happen every year consistently. This is stocks for the long run stuff. If you look at what we've done to the tax code in this country, they've created the 529 as being a multi-wealth generational type concept. I'm not a planner. I'm just an investment strategist. But if you look at Investment Act, the Secure Act 2.0, right, where there's those out year potentialities where you could almost Roth convert. It's not really clear what you can do, but it's if your 5.9 ages at least 15 years or something, you'll be able to do theoretically. The guidance is very clear. Roth conversions for all the kids, and then also the one that you open up in your own name, and then also the one that you open up in your spouse's name. And on it goes. And if you just start reading through the lines here, you've got the Trump administration. I don't know if this is just kind of like a little BS concept here, but this pro-natalist $1,000 account to invest in equities to teach kids how to, you guys know this one, right? This thing is part of the tax code that they're talking about.
It's the hedge fund guy, right? The hedge fund guy.
Well, it's going to be great news for BlackRock. It's going to be, and maybe T. Rowe too. I mean, you know, all the big money managers will get a piece of that $1,000 that each kid gets if that becomes law. But theoretically, a large proportion of these kids will hit 18 or 25 or 30 years old. And under normal circumstances, they would have never known anything about the stock market. But at that juncture, they will now have this account with $5,000 or $10,000, and they're looking at it and they're thinking about, I don't know, interest rates or what have you. That's an out year situation. But I bring that up as well because this is not just US centric, guys. We had the Brits in the last 24 months or so talking about the British ISA, which is kind of like their trad IRA, and saying, okay, how are we going to get close valuation gap with the Americans? I know, let's let you contribute more into your retirement plan so long as it goes into British equities. At the same time, and John, you know, I've been talking about this back on January 1st of 23. No, January 1st of 24. The Japanese tripled your max out on your equivalent of a 401k in that country. Tripled the annual max out. It was about 7,000 USD. It went to 21 or 22,000 USD. And then here's the final part of this, guys. And I don't know how relevant all this is to the conversation, but just thinking about stuff that could really hit home. Reforming the European system, getting the individual to buy your own home country stocks because you can't keep up with the NASDAQ and the NYSE. There are whispers about a European 401k, and I think it's a live possibility in the next 2 to 5 years that there's some sort of push there to DC contributions. It's Jeff Weniger's conjecture, but I think that's coming too.
But you were arguing something about earnings like being too expensive. I didn't understand bridging a gap between 24 times versus like all the 401k stuff. What was the...
Well, what I'm saying is this would be really, really bullish if the market was really cheap.
Oh, right.
But the market's at 24 times forward earnings.
Yeah.
We've had a bull market that you could theoretically date to March of 2009 with, 3 hiccups, COVID 2022, and then this action here. But generally speaking, is that whole bull thesis running right head first into a 24 forward multiple is basically what I'm saying.
Yeah. And if you take that multiple and do a forward earnings projection on there, it's about the forward yield on equities is comparable to cash. That should tell you about how deep you are into the market, into the bull market.
Yeah. I'll give you a personal experience from me is that I was very over levered on equities. There's that guy that wrote a book like How Do You Invest Your Cash or something like that. So as a portfolio manager, I would say I was sort of like very high 80s. And, I had restructured it after this rally to be more, kind of like 65, 35. And I just don't think you need to own as much equities now on a relative basis. I'm not saying I'm bearish, but I would counter Jeff to your point. Like, once you strip out the Mag 7 stocks, the rest of the equity market doesn't look that expensive, right? So whether you look at mid cap, equal weight, value, dividends, we're nowhere near 24. It's probably closer to like, 15, 16, depending on which factor I just said. So I still think I would take, 16 over, and, my parents were born in Sicily, right? So I'm very European, going to Sicily this summer, but I would just say, like, you'll never convince me that Europe is a better place to invest than the US when you've got the best, technology, regulatory environment, the best companies in the world, the best people, all the talent from all over the world comes into the US. I just don't think you should own the S&P, right? I think it's very expensive. So we run an ETF that's equally weighted just to kind of tilt away.
Mm-hmm.
And our ETF, past performance on indicative future results, but we've seen, good outperformance versus the S&P. So it just depends on how you cut and slice, your ETF, right? So what I see most advisors do is say, okay, I'm with you. S&P is expensive, so we'll buy, value stocks, right? So now all of a sudden, like your
Mm-hmm.
value ETF, it's going to have a very different sector composition compared to the S&P, right? It's going to be industrials, financials, which may or may not work. Some buy cash cows, right? Cash flow
Mm-hmm.
producing cows, the ETF, that'll have, mostly cyclical stocks, right? Some will buy dividend like DVY, STY, and that has very different sector mix. So really what you want to do as an advisor is kind of track the S&P plus or minus a spread. And then, you got to pick and choose the right ETF to do that. So, um, yeah, Jeff, you've come across as somewhat bearish, and you got Siegel on your side over there, who's seems like he's always, kind of bullish. What's his latest thought, and what's his latest rant these
Well, wait a
days?
minute. I'm coming across bearish. I got everybody's going to expand their DC contributions. We're going to have perpetual flows.
Yeah,
No, I think it's one of these things where I think I'm kind of like how you were, where things were. I was really, really excited about the prospects of getting long. We had the VIX sitting at 60, um, right on or around April 8th, because that's almost if again, past performance is not indicative of future results, but basically when the VIX is at 60, you should be buying with both hands. Historically, it almost every time works out to subsequent positive returns, with one asterisk being that if you bought when the VIX was in the 40s on September 17th, 2001, first session after we opened, now you're long throughout the rest of 2001 into 2002, and you're going like this with your NASDAQ and S&P 500. That's the one time where it doesn't really work. Um, I think that with respect to Siegel, we have philosophically some of the concepts in the Siegel model portfolios where I think we're tilting towards stocks for the long run. I mean, there's some of the mandates are, where they're basically benching them against classic moderate allocations, but they're more aggressive in equities. And we think that we can get more alpha generation from the dividend concepts. We're getting to the point where we're seasoning a lot of these mandates on 20-year numbers. In summer of 26 will be the 20-year numbers on the original dividend screens. And like the large cap value, the deep value, they're beating benchmarks. So things have been working. It's been doing well across mandates. But yeah, like look, the S&P's at 5,900, and 2 minutes ago it was at 4,900.
yeah,
I mean, literally last month it was at 4,900. So it's hard to be as bullish, especially because a lot of the snapback that you get from the sentiment extremes that I had been talking about at the time, like AAII bears. AAII bears had reached a 98th or 99th percentile reading. The VIX, as I stated, was basically at unprecedented highs other than intraday readings in October of 87. And so from those points onward, nice snapback metrics. But now a lot of the easy money has been made. I think it'll be a little bit of a slog through this summer.
yeah. Thomas, you guys have like a very impressive CIO. I saw him on CNBC recently, and he was talking about kind of inflation, real assets. I don't know if that's an area you can touch upon, but inflation does feel like it's stickier. I know these CPI, PPI prints this week, were a little bit lower, but that's all pre-tariff stuff.
Yeah.
Tariffs are inflationary by nature.
Mm.
Maybe comment on that.
Yeah, real assets is not my foray, so at the risk of sounding like an idiot, I'm going to go ahead and tap out on that one. But I will say, yeah, we think that the market is really sanguine to any potential risks from tariffs, specifically with inflation. That first part was a very, very obvious comment, right? A lot has been walked back, but think about it this way. You cannot unpickle a cucumber. So the tariffs, at the end of the day, they're still higher than they were when you walked in on April 2nd. So there is still some damage that's going to be done. There are supply chains that have gotten mucked up that are going to have to, still work their way and smooth things out. So while the impact, if the inflationary impact might not be as large as it was pre all this walk back, there are still going to be some pricing pressures. For that reason, we actually do favor inflation-linked securities like TIPS, particularly at the front end. So short duration TIPS, if you want to express that view, that's how we're thinking about hedging ourselves. Now, let's take a step back and let's think about inflation and just rates more broadly. So you referenced our CIO. We specifically have a fixed income CIO as well. He's been out there with a couple articles, and he thinks that the 10-year can actually go to 6%. That's a pretty lofty target, but if you followed his playbook throughout all this tariff volatility and were short duration and things like that, would have made a lot of money. Again, I don't know if we're going to go to 6%, but the path from here definitely looks like higher long end yields. Why? One, you have the inflation aspect that we just talked about. Two, fiscal stimulus is coming. Deficits still huge. And lastly, supply, not just US supply, but just global sovereign supply is going to be coming down the pike, and that's going to pressure long end developed market yields across the globe. So we are pretty bearish on rates, specifically the long end.
Wow, that's a very out of consensus view. That was really interesting. I have a question coming in from somebody. How do you feel about hedged international developed ETFs, as well as the direction of the dollar? Will the dollar appreciate to where interest rate differential suggests, or will it continue to fall?
That one's for me.
I was going to say I can take that. I can take that one as well.
Oh, okay. Go ahead. I assumed it was because of DXJ and the funds, but go ahead.
No. You take the DXJ question first. I'll give you my macro rundown on the dollar afterwards. Sorry.
Sure. I mean, what we've oftentimes said is one of the most difficult things to predict in the markets is Forex directionality. Figuring out whether or not the dollar is going to appreciate or depreciate is very, very challenging. And so what we've found is historically, if you have the equity mandate, like, DXJ or whatever it is, we've got a bunch of these. There's the equity mandate and you're currency hedged, that one of the appeals over these 5, 10, 15-year windows is the vol side of the equation. Now, we've had success through the years launching a lot of these around 2010, 2015, generalized bull market in the dollar. So we've had a performance story to hang our hat on, but you don't know how long the dollar can remain top of the heap. I mean, right now it's been a weak 2025 for the dollar. So the currency hedged mandates have struggled considerably, right? I mean, basically everybody was lopsided long dollar entering 2025. But I think that over the course of time, you get nice vol metrics. Now, then you have idiosyncratic issues here. Is it the same vol setup in Japan as in, for example, Europe? Probably not, because when you have risk off, you usually get big yen rally, right? I mean, it's a reversal of the yen carry trade. Think of August of 24, for example, your long Japanese equities and your currency hedged. We're going to have a sell-off in equities, and then suddenly it's going against you because the yen is appreciating. So I think that's probably one of the big asterisks on currency hedging, maybe cutting down vol. But on a lot of the other mandates through time, and maybe things will change in the future if there is the loss of dollar hegemony and some of the things that are in the conversation. And Tom was referencing, you got a $2 trillion baseline U.S. deficit annually with no sign of that closing. I mean, these are clear issues at hand. For what I will say next is that generally speaking, past tense, when you had market sell-offs, it was currencies like the pound, like the euro that ended up taking it harder than the dollar, because the dollar was kind of up there with Swissy and the yen as being the risk-off currencies that you wanted to be in various panics.
So if I could just add from a macro perspective, I'm gonna steal a phrase. I cannot take credit for this, but when you had the dollar and S&P both selling off, because your point, risk off, you see these, the dollar's supposed to act as a hedge. They were
Right.
referred to it as the macro unicorn. That very, very rarely you get this instance where the S&P is down, X percentage and the dollar is down as well. There are a lot of concerns that, oh my God, everyone is just dumping U.S. assets. They're moving away. Like we talked about divergence. I would say that story has not played out. You actually, in April, you saw net positive foreign buyers of U.S. dollar denominated assets. The US dollar is still the reserve currency of the world. Sure, there are other actors out there that are acting as, to balance things out. But I don't think that the dollar has necessarily lost its status. Also playing into that macro unicorn theme, typically in this tariff environment, you expect that a stronger currency is going to offset some of those impacts. So everyone thought, okay, we're going to get these crazy tariffs. A strong dollar and a further appreciating dollar is going to go ahead and take care of some of that. Clearly, that didn't play out, but luckily, the tariffs have walked back. Where you are seeing that, and that has caused a little bit of a disturbance in the force, if I can use a Star Wars, theme there, is with the Taiwanese dollar. So Taiwan, the Taiwanese dollar strengthened very, very strongly in response to inflation, growth, and as an offset to the impacts of tariffs. And that caused some concerns from particularly a U.S. credit perspective. Are people going to start to repatriate assets back to Taiwan, particularly the Taiwanese life insurance industry? That seems to have calmed down as well. But putting a bow on this, we have seen the dollar appreciate since all the chaos in April. We actually turned tactically long the dollar about a week ago. That's worked out pretty well for us. But then coming back to just, the yields you're seeing out there across the globe, you can still get a okay pickup as a foreign investor in US dollar denominated assets. But given how we've seen rates move across the globe, foreign credit still does, look attractive to other OUS investors. Sorry, that was a ramble.
No worries. We're going to start to kind of wind it down here. So Jeff, maybe just kind of start concluding thoughts on your side in terms of, real specific portfolio construction ideas. That always helps our advisors.
Sure.
Can't mention tickers, no worries, but to talk about, how much should you be overweight equity? What is the house view, right? Schwartz, Jeff, Siegel, like what do you guys,
Yeah.
are you overweight equities? Are you neutral, US, non-US? And then what's like the duration of your model portfolio?
Yeah, sure. And if it is just advisors and not, Mr. and Mrs. Jones, we can talk tickers. And harkening back, I think, to some of the things you were talking about when you said Mag 7 being expensive, but you look at the other components of the S&P. I mean, we've seen this kind of spreading out through the years inside the Russell 3. You take DGRS, for example, which is the quality dividend growth down in small cap land. Everybody's seen these issues down in small. We've been overweight this group, much to our dismay, right? Small cap has been underperforming for years. You're looking at 12 times forward earnings, and that's on a quality screen type mandate. So we like those ideas, but I would just point out, John, that in the model portfolios, we're not exactly gunslinging over there. Right. These are portfolios where we're saying, okay, we're going to move 2% from here, 2% to there, rather than, okay, we're all in, we're going to do some Paul Tudor Jones type thing over here. It's just not really the business model. And so we're almost permanently overweight small, permanently overweight a lot of these value type screens, the dividend screens. We have become more philosophically aligned with buybacks as a concept. As the firm has aged and as our society has become much more of a buyback culture than a dividend culture. And so that's where you're starting to see a lot of the screens. That stuff is showing up a lot more in the model portfolios these days than prior times. Currency hedging is something that we believe in, is a vol mitigator. So you can usually get a nice you can overweight equities, for example, relative to fixed income in knowing, and I'm going to use those air quotes for I know what's going to happen in the market. knowing that it will be a fall mitigator, wink, wink, on that concept. Within the various mandates, I mean, we have, we got European exposures, we have Japanese exposures and so forth, but in DM, we like Japan. We're still net overweight Japan relative to Europe. We think the TINA trade there is notable. We think that the reforms that are happening in corporate governance are real and still have time to filter into the generalized psyche. So that's the overweight in DM. And then over in EM, the big long-term play being China money rotating into India. We think that that has legs. We wonder how alone we are on that, though. Right? We're in it. This is a market that every time you open it up, you're up 21, 22 times forward earnings. There's no dividend policy in India. It's just not a stock market that will pay you a dividend, so you don't get that bird in hand. And so those are some of the notables, but think that we're in a sweet spot in that country. If you give me the 30 or 60 seconds on India, it's found itself to be lucking into a situation where it can play the Sino-U.S. conflict off of each other. I guess Tom agrees with me. I like to see that.
Oh yeah.
Evidence of India being able to get away with stuff. There's a $20 discount, $25 discount on Urals crude from the Ruskies. Can we call them the Ruskies? I guess we shouldn't. It's okay to say the Ruskies. The Russians. You had the $20 or $25 discount there for several years, which was a nice arb for India. And then you also have this repatriation. You got anecdotes, for example, Apple moving the production to India. Trump doesn't really like that much, but it is better in his eyes than China. And then, of course, a lot of the reforms that seem to have been continuing apace through the years in that country. So that's one of the almost, we'll see, structural longs inside
what's the duration on the fixed income side for you guys? Are you?
The fixed income, maybe a 4.5.
Okay.
Would be my best guess, and it would be back of the enveloping it.
Okay. Last question, and we'll get really into you, Tom, and your concluding thoughts. But on the international, are you doing like IHDG and an IQDG, kind of half 50-50? I know that was like Schwartz's big, do half hedge, half unhedged. That's kind of our philosophy, because we don't think you could really time dollar moves. Is that what you guys would use on your side?
Yeah, and there's also the concept of the variable hedge or the dynamic hedge in DTWM. And that one has come on more and more in the firm's, I'd say, viewpoints through the years. And it's a few-fold, if you will, in that, okay, John, so for example, let's say we come into your office this year, and you are a raging dollar bull at this year's client meeting. You're a raging dollar bull. And so you go into IHDG, right? You're hedging back to the dollar. You're telling me about the dollar. I'm just keeping my mouth shut. You love the dollar. And then the dollar runs on you and you get it right? The dollar goes up 15 or 20%. And now a year passes, we come back into the office, and now you're a dollar bear because you made the money. The interest rates have changed. The dynamics have changed. It's crowded trade, whatever it is. And now it's time for you want to liquidate IHDG. Well, if it's in a taxable account, we got an issue, because now you got to take the cap gain. So what we ended up doing years ago, we developed one that oscillates inside the ETF, the hedging. So you're hedged X% sterling, X% Aussie dollar, X% Swedish krona, and there's 15 or 20 of them. And then based on the metrics, you might be 70% hedged currency A, 25% hedged currency B. And so theoretically, when we have the client meeting with you, and you're saying, oh, this year I'm bearish the dollar, the reason you became bearish was because you were probably looking at the similar metrics that we were, currency momentum and so forth. And then that way you could perpetually hold the ETF through time. So that's the dynamic or variable currency hedge concepts. And we've had a lot of success with those.
Cool. All right, Tom, kind of asset allocation thoughts and where you guys are positioning and sort of your model portfolio side, to the extent you can chime in on.
Yeah, of course. Yeah. So as I mentioned at the front end, at the beginning of the call, underweight U.S. investment grade credit, within credit specifically IG, like I said, favoring OUS. We just think that there's better relative value there, and really trying to stay underweight the long end, particularly within treasury markets, for all those reasons I mentioned. We still favor high yield. Like I said, spreads have come back down, but they do to some degree reflect the potential uncertainty there. And, like I said, fundamentals are okay, different asset class than it was. Loans still look to be attractive as long as we're in this higher for longer environment. Taking a step back, where we like in strategies to think about, the front end of the curve, particularly low duration investing, still looks really, really attractive. And the reason for that is, when we were going through the sell-off, so spread to the front end have retraced, but when we were going through the sell-off, there was like a 2-day period where the front end was really getting whacked really, really hard. And the reason for that is basically, if you're an asset manager, you're an investor, where do you go to raise cash? You go right to the front end. So it didn't recover as quick as the long end. So we were able to retain some value there as well. Now, if you think about where we're sitting at, front end multi-sector investing specifically, you get such a good yield cushion, meaning your yield you get per your unit of interest rate risk is so compelling right now. It would take something like a 200 basis point move in yields to wipe out your current level of yield. Now, you heard me say that we think that there's going to be inflationary pressures, fiscal issuance, whatever. That's going to lead to a lot of a push higher in yields. That's going to be a long end, a bear steepening type environment. Sorry, I said beer steepening. You can tell where my mind is on a Friday afternoon here. But you're pretty well insulated at the front end, where you're going to clip a good coupon and you're going to have that cushion built in. Last thing I would say, I'm surprised you haven't asked this yet, Fed call for the year. Our view, our economist view, is that we're likely to get 2 cuts back half of this year. The Fed has the ability and the optionality to be patient. Soft data has been real soft. Hard data hasn't weakened yet. We got a good slug of hard data this week. It was soft, but nothing too crazy, right? Labor market still, it's not as strong as it was, but it's balanced. And so that's going to be the focal point that we're going to be looking at, and what the Fed's going to be looking at to really change the trajectory of that potential cutting cycle. So if it starts to loosen and loosen rapidly, which we don't think it will, that could lead to a faster cutting cycle, but we don't think that. And we're seeing some cuts, still continue to be pulled out of the market. That further just reinforces that short duration stance.
Got it. All right, a lot to be said. Thank you guys, really appreciate it. And special thanks to you, Thomas, for your firm. You're actually one of the sponsors for our macro summit.
Awesome.
Thank you for doing that. Actually, we just got Jeffrey Sherman today to confirm as one of our speakers. So we're really excited for that. Look, guys, I really appreciate this. This is always a good discussion. And if anyone has any follow-up questions, feel free to reach out to Thomas or Jeff directly. Thank you very much, guys. Really appreciate it.
All right,
Thank you.
perfect. Thanks, guys.
All right, thank you, guys.
All right, take care.
Appreciate it.